I'll go ahead and get us kicked off here today. I know everybody's got a busy day and needs to get on to other matters as well. So I have a couple of great presenters with me here today. I'm Karen Sanchez. I'm the Employee Benefit Plan Service Line Leader here at Sikich. I spent my whole career here, and I'm no longer going to say how many years that's been, but it's been a great ride for all the years here with the firm. Cassie Christ is joining us for another partner from our Employee Benefit Plan Audit Group as well. And Carrie Schrader is joining us from our Governance, Risk, and Compliance team, more easily said Internal Audit Group as well. She's going to share with us some of her insights over payroll controls that I think will be really helpful for us as well. So pleased to have this great team presenting with me here today. Before we get too far into that, again, wanted to remind you that we have the question feature in the chat, so you can include your questions there. We may try to address some as we go through the presentation. We may need to hold some to the end to make sure we get through all the content that we have here available today. If we do run out of time, we will get answers to you after the conclusion of the webinar as well. Again, you can download the PDF of the slides. If you need to receive CPE credit for you CPAs out there, as you're very well familiar, we have a couple of requirements we need to have fulfilled. We'll have 3 polling questions, or actually codes. We'll show you the software that we're going to use for that here in a moment. But we do need you to complete those as well. There'll be that survey that we need you to complete, and then certificates will be sent out to you via email in the next couple of weeks. Unfortunately, we were not able to provide the HRCI credit for the HR professionals today, so I do apologize for that, but we'll be able to do the CPE credit for today's session. In order to do the CPE for the CPAs, we're using another tool called conferences.io, I believe it's called. So I want to pause here on the screen for a minute. There's 2 ways for you to access the software, and we're going to put this in the chat box as well. You can either type into your web browser, navigating to this https sikichevents.cnf.io. That'll open up a web page for you to enter the code in there, or you can use your phone and this QR code to pull that up as well. If you're on your phone, we have the image here where you should be able to see that. You're going to want to check into the conference, and then the code words will be a series of numbers that we'll provide throughout the webinar. So I'll give you another minute here if you want to scan in the code. I personally go old school and just type the website address in versus trying to figure out my phone. I do figure out restaurant menus and things with the phone fine, but on this one I've stuck with the website address. Again, we'll put that website address in the chat if we haven't already as we go through the session. So the first code to practice this is going to be 117. The first code is 117. So you should have checked into the session, typed the code in, and hit enter, and it's going to keep a running list of the codes. Thankfully, we only have to do this 3 times throughout the presentation. And if you've missed this code, just put a note in the chat and we can get that over to you later as the session progresses as well. All right, so with that, just a little bit about Sikich. Last year, we actually did about 500 plan audits. So we're not going to say we know it all, but we've seen a lot. Within that period of time, we're doing all plan types, all plan sizes within the practice. So excited to get launched for this next season and share some information with how we can make these audits more efficient for everybody. Overall, Sikich, for those of you who aren't familiar with us, the firm's been around a little over 40 years now, about 1,600 employees. We have employees in just about every state as well as across the globe. We're providing services, and we've got about 130 partners today. In addition to the audit side of benefit plans that we're talking about here today, we offer the full array of other audit and tax services you would expect in a traditional CPA firm. In addition, we offer an array of advisory services from human capital, wealth management, investment banking, marketing, and a large array of technology services as well. One of the areas that we've grown in is really looking to see what clients are asking for in other services, and then finding other business partners to bring into the firm to offer those to our clients. So we hope that we are able to fulfill clients' needs in a variety of different ways. Sometimes it's easier to say that we just don't do welfare or brokerage services and legal, but we probably do the majority of the other business services that you might be looking for. So usually just reach out with questions, and we'll see if we have a resource within the Sikich family, and if not, can help assist you getting connected to get your answer handled. So today's agenda, what we wanted to cover is kind of talk through some of what your fiduciary responsibilities are and the internal controls that can assist you in fulfilling some of those. Talk about some common plan administration issues when those controls aren't operating effectively. There are consequences when the controls aren't operating properly. Things to think about when you all are in the process right now of filling out your compliance testing questionnaires with your third-party administrator. And then bringing that home, helping tie it together about how we can make the audit more efficient for you in the coming year. We did have some 5,500 changes for the first time in many years, so we wanted to cover some of those so you can be familiar with what you're going to be seeing when those 5,500 drafts come across your desk in the coming months. So we're going to kick off with the fiduciary responsibilities. Really, plan sponsors, plan administrators, trustees are all considered a fiduciary under ERISA, which is the Department of Labor regulation that many of these rules fall with under. So fiduciaries can actually be held personally liable if they're found to not follow the basic standards of conduct. Many organizations have fiduciary insurance purchased to cover you on that. I know personally as a plan trustee and administrator on our plan, we want to make sure that we have the coverage there, that if there is an issue that you're personally covered for your role in fulfilling that for your organization. Some of your fiduciary responsibilities include maintaining the financial books and records of the plan, filing complete and accurate annual return report for your plan. That's where we come in with the audit that accompanies that form. And really it's all the things that build up to satisfying those two, seemingly simple things to do, but the devil's in the details and all the things that happen behind that and all the level of participant details, record keeping, all the different things that fall into making sure that the participant's experience has been handled properly in contributions. So one of the ways that you can fulfill those fiduciary responsibilities is implementing appropriate internal controls over financial reporting. When those controls are effective, you've got some reasonable assurance that all of your plans, obligations, and reporting is going to be handled properly. When you have gaps in those controls, that's where things can go awry, and there could be significant additional contributions owed to the plan to make corrections, payables, things of those nature. So Carrie's going to cover for us today some items on internal controls and how those can help you fulfill some of those fiduciary duties. Carrie, do you want to take it from here?
Sure. Thanks, Karen. So before we start on internal controls, for many companies of the same size, magnitude, and even industry, your internal control is very, very different. It depends on the number of resources, it depends on the technologies that you have employed. But let's start with, what are internal controls and why they're important. They are the processes that are put into place to provide reasonable assurance that you can meet your objectives. Those usually are around operations, reporting, and compliance. They're important because they provide the policies, procedures, and rules for accuracy and integrity. They also can help you to prevent fraud, to support the compliance with laws and regs, and also help you to identify some of the efficiencies, which we'll talk about in a later slide. We have three types of controls: preventative, detective, and corrective. And your preventative controls are the strongest of the controls that you can put in. Those preventative controls keep those errors from occurring. So in the payroll space, that could be where you are approving your payroll before it's processed. It'll stop it before the errors occur. Your detective controls find those errors. So those in the payroll space could be after your payroll is processed, you're reviewing a report, and you're identifying those errors at that time. And then your corrective controls will correct the problem after you've identified those errors. And so sometimes it has to do with a system calculation that has gone awry. And so you have a process in place for changing your systems in order to correct the control. Your controls can come in either a manual or automated fashion. Your automated controls are your strongest of your controls. Those are designed and performed within a system, and once designed appropriately, they'll trigger, and they'll trigger consistently. On a manual control perspective, they are subject to human error because an individual actually performs them. You can have it to be IT dependent, where they are waiting on a report, and then they review that report on a manual basis. But if that person were to be sick and you don't have a backup, that's where your risk and exposure lies. There you go. We usually look at internal control processes in three tiers. So from an operations and applications layer, in this case, our payroll processes. Our data layer, in a lot of cases for the payroll side, is housed within your master file data tables, and then your underlying general computer controls. And we'll go into each of these 3 tiers in the next few slides. So for your payroll process, again, it really depends on your industry and the amount of people, whether they're manual or automated, as to how these are designed. But for onboarding of individuals, you want to make sure that your individuals are valid and they're authorized by management, and additions to the payroll files are independently reviewed for accuracy. We also highly recommend that any access to those employee data files is appropriately restricted, and you will see access as a common theme throughout a lot of these slides. From an employee termination standpoint, you want to make sure that that termination is changed timely within your system, and your benefit providers are notified of that change date so that those benefits can be shut down, as well as employee access to your payroll is been terminated. From a time entry standpoint, time entry needs to be reviewed and approved. Watch out for your overtime. Sometimes it doesn't always occur on a regular basis, and some companies actually forget to review the overtime feature, and sometimes those are double or triple the amount depending on what your overtime policy is. Review your data for anomalies. This is a perfect opportunity for data analytics to be employed. Instead of looking at a sea of data, you're isolating what those anomalies are so you can identify them timely, investigate, and correct those. And in many companies, there's time and badging systems that interface with your payroll system. So if you do have that separate system, making sure that that interface is complete and accurate. From a calculation standpoint, whether you do it in a system or manually, you want to make sure that those calculations are accurate. Again, here, another opportunity to identify those anomalies timely and get those corrected with possibly data analytics. And then because it's payroll and there's a lot of times a third party that processes the payroll, that payroll is transmitted to your third party timely, completely, securely for data integrity. And the last column is in regards to accounting records and making sure that your payroll accruals are reviewed, your account reconciliations are performed timely, and then access to your bank accounts are appropriately restricted in their segregation of duties. In the second tier down, that is really where your master file data sits. Usually when you have systems, it sits in data tables. Additions to these data tables need to be reviewed and approved prior to implementation, and access again here is highly recommended. From a change standpoint, we want to make sure that your changes to your tables are authorized, they're tested and approved. This is an incredibly important part, making sure that those calculations or any changes you make to your tables are reviewed. Access to those tables are restricted and that changes are approved prior to putting them into the system. Any significant changes to your master file should be reviewed. In the payroll space, those can be things like year-end increases, bonuses, incentives, large chunks of data that are changed at a certain point in time. Your individual transactions need to be reviewed, but these larger ones, they need to have some scrutiny over. Your withholding tables need to be updated timely. Your withholding tables need to be updated timely and accurately. Those can be done by pushing over data electronically, interfacing and updating those tables, or somebody manually keys them. The risk and exposure is higher when somebody manually keys, so make sure that those are reviewed and that changes to those are reviewed and approved for accuracy. We've also included some fraud red flags, again, looking at anomalies within your data, within those tables and the changes that are made and investigating those. And then also looking for ghost employees in the payroll space. You can do that by bouncing your payroll data master files up against your human resource files to make sure that they're all true active employees. The last tier is in regards to information technology general controls, and we usually look at those in 3 buckets: logical security, change management, and IT operations. From a logical security standpoint, you want to make sure that users' access is reviewed and approved, but you also want to make sure that they're using a least privileges rule. A least privileges rule only provides you access to systems in which you use to do your job. If you have too much access, it's inappropriate and could cause some errors to your data if someone was inadvertently able to change it. The next piece is in regards to having unique user IDs and passwords. Don't share IDs and passwords. It makes it clearly impossible for us to go back to determine who has made a change to that data and determine it could be legitimate, but sometimes we need to understand who made the change and why it occurred. Your last piece under logical security is under privileged access. You want to make sure that's a limited appropriate personnel, it's logged and it's reviewed. That is your most powerful ID into your systems. Those are your administrators. You want to make sure that those are kept to a minimum. Under the change management, particularly in the payroll space or anything on regards to financials, you want to evaluate those in regards to your cutoffs, your month-end, quarter-end, or year-end cutoff timing. If you don't need to change the application at that time, it's recommended that you wait till after the close period or that cutoff in order to make sure that if your system is currently stable, then you don't want to make any changes. If you are a public client and you go by SOX, SOX goes through a 3-month freeze period in which no changes are made to the system unless the system is going down. So you want to make sure there's some integrity there and you can get your close done as quickly as possible. Changes to your systems are tested, reviewed, and approved prior to implementation. And that access to making those migrations to changes into production is not the same individual that's able to develop the change. It creates a segregation of duties between the two functions. Have a process for emergency changes and controls in place. They're going to happen. It's going to happen at 2 a.m., the most inopportune time for a system to go down. However, those changes need to get put in place, and most companies will have the day after. There will be controls that are put in place where management reviews and possibly does some additional testing of those emergency changes that were installed. IT operations seems pretty basic, but it is very important to cutoff as well as to calculations. Those job schedulers need to be appropriately restricted. Jobs usually run in a certain order so that calculations can happen or cutoffs can occur. So you don't want changes to be made to the schedule unless they're approved. And then the last piece here is in regards to failures in the job scheduler. If you have a job that is running and it fails, it might actually fail the whole job where it needs to have it run fully again so that you have the complete and accurate data, or it might just actually kick out 1 or 2 transactions. Those still need to be corrected before you cut off. In regards to considerations to putting in your internal controls program, there's a bunch of benefits. It increases the collaboration between departments. People understand the downstream impacts of their process and their controls. You can maximize some efficiencies in the process, and it also provides for a sound control environment. From the point of understanding where to put your time and your energy and your limited resources, a lot of times when you're actually looking at your process and you have clear documentation, whether that be in policies, procedures, whether it be in narratives, or we like to see flow charts as well, because they can pictorially see where you have a low risk and you might have multiple controls. If you have a high risk and there's no controls, move some of that energy, that effort that you're taking from your low risk areas and move those over to the high risk areas. So it's just shifting that to reduce risk for the organization. The last piece is to, once you have that mapped out, you can look for considerations to put in the strongest of controls, those preventative and those automated controls to maximize your control reliance and reduce the risk of failure. We talked a little bit about establishing documentation and communication. Make sure you understand all the processes that impact your plan. Have all the individuals there for discussion when you're actually mapping out and understanding what the process is, as well as to support it with documentation, policies, procedures, narratives, flow charts. Those all are strong documentation. Make sure that that your staff is trained in the key elements to make sure that you have a strong internal controls plan. And last but not least, we talked that in the payroll space, it is very common to have an outsourced service provider. You do want to make sure that they have adequate controls in place. They are part of your fiduciary function, and that you do want to make sure that you're periodically reviewing and monitoring them. There are such things as user control considerations that you need to have in place on your side. It is not uncommon to ask your service providers for a SOC report. That SOC report will test their control environment and show you where there is any potential for weakness. It also does provide you the user control considerations that need to be in place on your side by that service organization. And I think the next step, we are up to another CPE check-in. If you scan that QR code and enter 622, I'll give you a couple of seconds to do that before moving over to Casey on the common plan administration issues.
Thanks. I'll give you one more moment here. The code is 622. If anybody missed it, just put that in the chat as well, and our team can get that over to you. Cassie, if you want to go on the next section.
Perfect. Yeah, and if you want to move to the next slide, Karen, that would be great. So in this section, we are going to talk about some of the common plan administration issues that we see. We recognize that there are a multitude of operational errors and issues that may arise in an employee benefit plan audit. However, for purposes of today's webinar, we are going to focus on those related to contributions, including compensation considerations. This slide here summarizes some of the common operational errors that we see related to contributions, including incorrect definition of compensation, incorrect employee deferrals and employer contributions, as well as the untimely remittances of employee deferrals to the plan. Okay, next slide. Sorry. So as alluded to in the previous slide, there are a number of items that can cause operational deficiencies in relation to contributions, one being timeliness of remittances. The Department of Labor requires for large plans with 100 or more participant accounts that the employer segregate employee contributions and loan repayments from its general assets as soon as administratively feasible, but in no event later than the 15th business day of the following month. Now, it is important to note that the 15th business day of the following month is not a safe harbor for depositing deferrals. The guide that the Department of Labor uses is that plan sponsors should be remitting deferrals in the same time frame as their payroll taxes, which is generally within a few days of the payroll having been processed. Any untimely remittances that are identified are deemed to be prohibited transactions. Missing contributions altogether is also another common of operational deficiencies that we see. Missed contributions can either be attributable to one or more participants or could be for an entire payroll period. It is management's responsibility to ensure that all contributions calculated and withheld from payroll are being remitted to the plan. Definition of compensation is also another big area where we tend to see a lot of errors, especially in a first year or initial audit engagement. Eligible compensation is defined in the plan documents and differs from plan to plan. Again, it is ultimately management's responsibility to validate and ensure that payroll codes properly align with the plan's definition of eligible compensation. And lastly, here on the slide, entry dates are also another area where we see common deficiencies. If a participant is not enrolled timely, they may actually be missing out on contributions and related earnings. If they are enrolled prior to becoming eligible, the plan is out of compliance with plan provisions, and the participant likely deferred a compensation that was not yet eligible. Now, I know this slide seems very doom and gloom, but the good news is that there are processes and controls that can be implemented to help prevent these errors and issues from occurring. We recognize that perfection is nearly impossible in any employee benefit plan. So if you do come across any errors or issues related to your plan, please know that we are here to help. There are plenty of correction options and programs to get your plan back on track. So now let's talk about some of those preventative measures. As discussed in the previous slide, untimely, inaccurate, and/or missing contributions may result in improper plan recording of contributions, missed earning opportunities for participants, and prohibited transactions. Some of the controls that we note here that plan management should consider implementing to reduce the risks include comparing the inputs into the contribution calculations with the plan's definition of eligible compensation. And remember that the definition of eligible compensation may be different for employee versus employer contributions. Also, reconciling contributions per payroll to the trustee, custodian, or other third-party administrator reports to ensure the completeness and accuracy of contributions remitted to the plan. It's also important that management maintain control totals for participant and employer contributions in order to validate proper remittance and allocation to the participant accounts. Now, when it comes to deferral rates, it's also important that changes received from third-party service providers are updated within the payroll system in a timely manner and are also reviewed for accuracy, as Carrie had mentioned above, including any potential spot checks for systems with 360-degree integration. And lastly, it's also important to have policies and procedures in place to ensure that participant contributions are remitted to the plan within the DOL guidelines, as we discussed above. Employee vacation, turnover, blackout periods are generally not an acceptable reason for a delay in remittance. And as such, the plan's policy should include a backup plan for remitting contributions when these events occur. We also recognize that not all processes and controls related to contributions reside at the plan sponsor. Once contributions are remitted to the custodian, it then becomes the custodian and record keeper's responsibility to adequately safeguard the contributions, process them in a timely manner, and properly apply them to the appropriate plan and participant accounts. So how can you determine whether a service organization has the appropriate processes and controls in place to safeguard your plan's assets? Well, as Carrie alluded to above again as well, most service organizations provide an annual service organization report, or a SOC 1 report, which includes a report from an independent auditor that addresses the adequacy of the service organization's internal control environment. Common controls that we see at the service organizations related to contributions include the confirmation of transactions for proper authorization, as well as the distribution of quarterly and annual statements to both plan administrators and participants to further validate the authorization and accuracy of transactions. Plan management should also have procedures in place to follow up on any issues, discrepancies, or reconciling items that they are made aware of at the service organization. Additionally, policies and procedures should be in place at the plan sponsor to help protect the confidentiality of login information to the service organization portals and further ensure that access is limited to only authorized personnel. The key takeaway here is that if you are not currently obtaining your SOC reports or related service for your related service organizations, we strongly encourage you to do so, and also ensure that only authorized personnel have access to those portals. Karen, next slide now. So when it comes to processes and controls related to compensation, first and foremost, plan management should read the plan document to know what the definition of compensation is for both employee and employer contributions. Additionally, just because compensation was correct in prior year doesn't mean it's accurate in the current year. Plan sponsors should consider the impact of things like plan amendments, changes in payroll personnel or payroll service providers, any new payroll entities that were added as a result of an acquisition, any new pay codes that were added during the year, any potential one-off payroll cycles during the year, and then also any non-cash awards such as share-based compensation, gift cards, or other prizes or awards that are given to employees. This is why we suggest a regular reconciliation be performed between the plan document and payroll to ensure that contributions are being calculated based on the plan's definition of compensation. And lastly, as further noted here and in many of the previous slides, access to the payroll system should also be restricted to appropriate personnel, properly segregated and periodically reviewed. Validating the accuracy of employee deferrals within payroll is also a key process to ensuring the appropriate amounts are calculated, withheld, and remitted to the plan. When it comes to payroll, we recommend the following processes and controls be implemented by plan management. First, pay rates and hours worked should be approved and validated for accuracy within the payroll system so that the appropriate compensation amounts are used as the basis for determining contributions. Similarly, participant deferral elections should be timely and accurately entered into payroll as well. If changes in deferral rates are received from the plan's third-party service provider, the changes processed within payroll should be reviewed for accuracy. Additionally, and to alleviate any potential errors in authorized deferral rates, the plan sponsor should consider a single documented source of truth for all employee deferral elections, whether it be the record keeper site, the plan sponsor benefit portal, or signed election forms maintained in personnel files. Additionally, IRS and plan limits on compensation and deferrals should be updated and reviewed annually for accuracy within payroll, especially if they require it to be updated manually each year. And to reiterate again, I know we're going to keep saying this, but again, access to payroll systems should be restricted to the appropriate personnel, especially in cases where they have the ability to make changes within payroll related to personnel information. So in addition to the process and controls mentioned in the previous slides, here are also some best practices that we encourage plan administrators to implement. I'm not going to cover all of these, but I do want to highlight a few of these items, especially in the documentation area. So first, having a dedicated individual responsible to take notes of plan committee meetings is really important, particularly when there's a discussion of any approvals related to the plan. Maybe there was a plan amendment or another significant change related to the plan. Maybe there was a decision to freeze or terminate the plan, or even how about an approval of a discretionary employer contribution. Those type of things should be captured in those minutes and documented accordingly. Also, having access to all executed plan documents. While the plan's TPA may retain these documents, it is still management's responsibility to ensure that all plan documents are complete, accurate, and properly executed in a timely manner. Additionally, having documentation for those individuals who elect not to participate in the plan, especially if the plan does not have an automatic enrollment feature. In this case, if the plan's record keeper or TPA is responsible for notifying and enrolling participants, it is still plan management's responsibility to understand this process and ensure that the service provider is providing timely written communication to all eligible employees so that they have the opportunity to participate in the plan. And lastly here, it's also important to maintain certain participant data support, including employee demographic information, hours worked, compensation changes, and changes in status as well, in order to validate both eligibility as well as the accuracy of contributions. Lastly, for this section, when it comes to processes that are outsourced to a third-party service provider, plan administrators should first and foremost consider the prudent selection and continuous monitoring of the plan service providers. Additionally, plan administrators should obtain and review all contracts with plan service providers to understand their roles and responsibilities related to the plan, and also ensure that those duties are being properly carried out. Additional suggestions that we've noted here for overseeing the plan service providers include reviewing the service organization fee structure and performing a regular benchmark analysis to validate the reasonableness of the plan's fees. And as previously noted, reviewing the SOC reports for the service organizations is also important, including consideration of any complementary user entity controls. Also validating that the plan service organizations are processing transactions timely, that they're confirming transactions are properly authorized, and resolving any issues or complaints that come about in a timely manner. And lastly, plan administrators should confirm that cybersecurity policies and practices are also in place at the service provider level to help ensure the security of the plan and participant data. Now I'm going to turn it over to Karen to discuss some of the key considerations of your plan's annual compliance testing. Karen?
Great. Thanks, Cassie. So many of you are probably either completed your compliance testing process or in the process of doing it. Many of the record keepers require that to be submitted sometime in January. So we wanted to provide some thoughts and hints along the way of things that you can do now that will streamline the testing process as well as the audit process. One of the things, as Cassie mentioned before, one of the controls to have in place throughout the year, but particularly at the end of the year, is that when you're submitting that census file, make sure the totals agree back to what came out of payroll. The census file is generally produced by an export out of your payroll system into Excel, typically, and should represent the entire population of all your employees. Anybody who got $1 paid in calendar year 2023 should be listed on there. Typically want that entire population, and then your plan, your third-party administrator may be telling you to code people who are not eligible for the plan in certain ways. But typically they want that full population, but then list categories if they're union employees. Are they in an excluded class per your plan document? People that don't meet the plan's eligibility. Those of you with a lot of part-time employees, hopefully you're following along with some of the changes coming up, and that long-term part-term employees is a new term. Or newer term, but those folks need to start to become eligible in 2024 into your plan, which requires a look back to looking at this data for the past couple of years to determine the hours they're working. Some record keepers or third-party administrators are helping you track those hours, but they need that data in order for their processes to work appropriately. So again, typically, obviously coordinate with your record keeper about what they're asking for, but we typically see that we want to see gross compensation, total numbers here, and that should tie back to the the total on your payroll report, your W-3s, all those for the total population of payroll that you're reporting. It's also an opportunity to look at all those contribution fields to make sure that those align with what came out of your payroll system as well. I know it sounds very, very simple, but many times when we ask for the census file and we ask for the supporting payroll documentation, we do see differences for a whole number of reasons between those two. Once you feel that you have your complete census file tied out to your payroll, also it's a great opportunity to implement another, those controls that Cassie mentioned, is to make sure that the contributions in that census file tie back to the deposits that you made with your record keeper throughout the plan's year. You might have to adjust for timing. Some of your 2023 contributions might not have gone in until January 2nd of 2024, for example. Same thing on the front end of the year. So taking into account those timings, really there's no reason that employee deferrals should not match exactly. Those employees want to know that what you took out of their paycheck made it into their accounts. So identifying that in total upfront streamlines the process. You can early identify these differences. Sometimes, we'll see a small difference, a few $1,000s. But what's interesting is when you dive into the details, sometimes you have a whole number of people overpaid into the plan and a whole number of people underpaid into the plan. Situations where you had a special payroll done during the year, or you had a correction to your payroll. Sometimes they'll avoid a paycheck and reissue another one. And that initial file feed goes in, but some of those corrections don't go in. So certainly reconciling this at the end of the year, we recommend that clients have a reconciliation process throughout the year to be looking at an accumulator in your year-to-date payroll numbers and your year-to-date deposit numbers, and checking that throughout the year because it really allows you to capture and correct those timely throughout the year. It's also an opportunity to look at excluded compensation. As Cassie mentioned before, your plan may not count total compensation as eligible compensation. So typically the record keepers would still want gross compensation, but if you're excluding bonuses or commission, for example, typically they're going to want those categories as well so that they can calculate the plan's eligible compensation for purposes of that compliance testing. It's also an excellent opportunity to look again at what those excluded categories are and make sure that those align with your plan. Sometimes if you have excluded compensation, there's another test that needs to be performed to ensure that your plan has a non-discriminatory definition of compensation. We saw a few clients this year where it had been fine for many years, but all of a sudden because of their workforce issues, they had a lot of overtime. Overtime was excluded from the plan, and they had so much overtime that actually it became deemed to be a discriminatory practice, and they had to go back, amend their plan, and actually make additional contributions on that. So again, another opportunity to take a look at that. Their plan had been fine in prior years, but their payroll pay practices changed, and they needed to update and consider the impact that had on the 401k plan from how they were paying their workers. Other considerations, if you're using leased employees, and just make sure your plan document, again, excludes leased employees from participation in the plan, which is completely valid safe harbor exclusion. See, sometimes people have long-term leased employees. We've seen, folks that they're leased for 20 years. They work aside regular workers that are employees and so forth. There are instances when they might have to become eligible for the plan if they're long-term. Most people after a 12-month period are bringing them on board as employees, but just another area to take a look at. Again, just any other people that you're excluding from the plan, make sure that you have covered that in your plan document. You're working with your third-party administrator to make sure it's not deemed discriminatory, and make sure you're focusing on any of those part-time employee rules if it relates to your organization, because those are changing and you may need to be making some offer coverage to that population of your employees to comply with some of the Secure 2.0 rules as they're being implemented. Related entities, there's usually a question on there. Your third-party administrator is relying on you to tell them if there's any other entities that meet the IRS's definition of being related. They could be control groups from an ownership perspective, or they could be others that you are doing so much business with, they're deemed to be affiliated service group rules. So make sure you understand who all is included in that entity. That can be a very costly mistake if they're not included in your plan. Even if you have another entity that's considered related, you may have to test the two entities together, and you need to have coordinated with your service providers who's going to do that testing and go through the process, because this can be a very time-consuming process to get not only the individual entities testing done, but determine if you're testing individually or in the aggregate there. If you had a decrease in your workforce during calendar 2023, one of the rules or the levels to consider is that maybe if there's been more than 20%, it may have had what's deemed to be a partial plan termination. If that happens, those participants that were impacted might need to be 100% vested. So if there were forfeitures that were pulled out of their account used for contributions or expenses, those might need to be restored. 20% is not a magic number. It's a very facts and circumstance type of test, litigated in the courts oftentimes, and it's not a point in time. It's looking at a series of events over potentially years that could accumulate up to this number. So just if you've had significant, reduction of force, a handful of employees terminated, another group, take a look back at that and see kind of what the cumulative impact on your organization has been. And if you have forfeitures that were occurring, take a look at those. The sooner you look at it, the better, because you haven't used those funds for other purposes. And oftentimes when there's a reduction in force, there's profitability considerations, and cash flow is a consideration. And so coming up with that extra money is never good news when we share that with folks in the audit process. Cassie mentioned the review of the timeliness of employee contributions. Great time now to take a look at that. If you've tied out your contributions in total, also take a look at the timing of when those occurred. See if there was any variations in that or anything that's going to be late. Great opportunity to bring this to the attention of your service provider. Work with them. If there was a late contribution, there is a corrective payment for lost earnings required. And on the audit side, there is no materiality for what we need to disclose. So if it's $1 one day late, we have to disclose that amount. Some service providers are more difficult than others to get these late contributions reported properly on the 5500. So I feel like early detection, I'm going to do a medical spiel here. So early detection is great. Find those errors early and those issues so that they can be treated and dealt with timely so that they don't become more problematic in the audit process later. I have to find something on here, some analogies to something, right? On your compliance questionnaire too, again, making sure you've taken into account what amendments you changed during the year. Oftentimes you're using the plan document or your provider and they should know that. But if you were a safe harbor plan and you suspended that, that might require compliance testing you didn't need in the past. Just taking a look at what the impact of those are. For those of you who are partnerships, LLCs, sole proprietors, any of those entities that have self-employment income, when you fill out those census questionnaires, keep in mind that if you haven't finished your tax return, you probably don't know what self-employed compensation is unless all those individuals are at the maximum compensation limit. The definition of self-employed compensation has several different variations. You start with taxable earnings on your K1, you subtract out, well, you probably don't want to hear the whole thing, but there's variations that you make to that calculation for what is going to be deemed plans self-employment compensation. It's not just the guaranteed payments that were paid to the partners in cash flow during the year. So you want to make sure you properly communicated with your third-party administrator the self-employment earnings of those individuals, and probably if your tax return is not done yet, which on January 17th, most of them are not done. So if you've submitted that census file, you might not have final self-employment compensation for some of those owners in your plan. And why do we care about compliance testing as it relates to the audit? Well, in the financial statements that are presented with our audit opinion, there's a paragraph in there where we have to indicate that the plan is satisfying the tax qualified status. All these tests that your census data is used as a basis for, all of those need to be run. And if there's not proper data that's being used in that process or the tests aren't run, it could affect the plan's tax qualified status. In order to retain that tax qualified status, you might have to make corrections to the plan. You might have to make additional contributions to participants to pass testing, or you might need to pay and refund monies to those participants to satisfy the testing. Either one of those could require an adjustment to the financial statements, either with a receivable or a payable, to properly reflect the plan's financial statements. So we typically need to see that compliance testing before we're done with the audit. If by the time we're doing the audit, compliance testing, that census file hasn't been submitted or it's not done, oftentimes you're sort of back of the line with that record keeper or third-party administrator, and we could be waiting months to get those results. So most of the time it's first in, first out. So if you can submit your information timely with the process, then you'll have those testing results completed. And then it won't be anything being held up within the audit process when we get to that. Oftentimes, they also won't draft your 5500 until the compliance testing is done. So you can kind of see where it's just a domino effect, right? If we don't have the census file done, we don't have the testing done, we don't have the 5500 done. So we become on hold and can't complete the audit timely when those things aren't done. The final code is 707 to enter into your app. So 707 is the next code that we have. So I'm going to turn it back to Cassie to help with some additional items on how to make the audit process even more efficient for you.
Perfect. Thanks, Karen. So how can we work together to ensure a successful and efficient audit process? Well, most of the following items here are relatively basic, but they are still really good reminders for clients and audit teams to adhere to. A few of the ones that I want to highlight below, because I'm not going to go through all of them, but the first one is gathering audit information ahead of the audit. Again, seems pretty basic, but what I wanted to point out here is that this doesn't mean just the information that we need from you as clients. It's also important to make sure that you're coordinating any information that comes from your plan's TPA or other service providers as well, as it may take a little bit more time to get that information from them. Also, developing a timeline and adhering to it. You know, what I often refer or recommend my clients do is that they start with the end in mind. When would you like to have the audited financial statements issued so that you can file your Form 5500? And then kind of work backwards, taking into consideration any vacations, holidays, projects, or other commitments that you might have. Also, communicating changes in service providers as soon as they are known. And the reason why this is really important is because access to information and resources at your former service provider may become very limited after a change in service provider. So it's important to work with your auditor to understand what information we may need to get from those previous service providers so that the information is available for the next period audit. Also, reviewing the financial statements timely in conjunction with the draft 5500. As management is ultimately responsible for the completeness and accuracy of the financial statements and related schedules, even if they are drafted by Sikich. Lastly, plan management should also review and reconcile plan information prior to the audit, as we've already mentioned above, including reconciling wages, contributions, and loan payments to census, which Karen mentioned, as well as between payroll and census, as well as reconciling data between custodial reports and participant records. And furthermore, if you do identify any errors during your reconciliation or review process, make sure that those get corrected as soon as possible, as well as communicated to your auditors. So documentation is also key to ensuring an efficient audit process. Plan sponsors should be prepared to provide all relevant minutes of meetings, plan documents, agreements, any policies and procedures that you might have, as well as any audit package support that you have available. While the plan service providers may house a lot of this information with their third-party service providers, it is still management's responsibility to make sure that all documents related to the plan are properly maintained, up to date, and formally executed as necessary. And as we've noted above, it's also important that plan management perform required reviews and procedures related to these plan documents and further document their reviews. So reviews of items such as the SOC report, the investment certification is another good one, plan controls and procedures, maybe fraud inquiries that we provide, documenting the results of your compliance testing, and the Form 5500 should again be documented and provided to the audit team for support. And we do, the good news is we actually have a lot of example templates that we can provide to aid you in that documentation of your assessments. As also noted for the slides above, the audit planning call is a critical component of the audit process, as this is where we generally take the time to learn about any significant changes or matters that could impact our audit and/or the plan's financial statements. In preparation for this meeting, we encourage plan management to be ready to discuss any known changes, the desired timing of the audit, identify who the designated contacts are for the audit, as well as validate the use of and access to various auditor, clients, and/or service provider portals. Subsequent to this initial meeting, we also encourage our teams and clients to have regular touch points during the scheduled audit fieldwork, as well as wrap up, to go through any open items, address any potential issues that were identified, because really what this will help with is ensuring that there's no surprises on the back end, and also ensuring that, again, we're adhering to that timeline that we mentioned above. And then lastly, we want to leave you with a few reminders on cybersecurity concerns and service provider monitoring, which we've already mentioned above, but I won't go into significant detail on these, but there are some really good reminders and tips and resources here for you to leverage, including a reference to the guidance issued by the Department of Labor on cybersecurity. And the reason that we mention this is because this is very much becoming a hot topic for the Department of Labor, especially in any inspections that they're performing. I've heard some clients have, 1 to 2 pages of questions just related to cybersecurity when the Department of Labor comes out to do an inspection. So it is really important to make sure that not only cybersecurity concerns at your service provider, but those that are relevant to your internal processes as well, related to payroll or any other HRIS systems, to make sure that you've got the appropriate policies and procedures in place related to cybersecurity. So now I'm going to turn it back over to Karen to take us home on some important 5,500 changes this year.
Thanks, Cassie. From a 5,500 perspective, it's been a number of years since we had any changes on it. There's been a number of things in the works, but often things in the regulatory space get delayed. So this year we have quite a few changes that are coming into place. Many of these will be somewhat transparent to you as you receive the 5,500 draft from your service provider, but wanted to make you aware of some of the things that you might see and really kind of the purpose of why some of those things were added, as they might be other initiatives that are being done by Department of Labor or IRS. So I'll go through a couple of these here. Certain types of groups of plans have a different schedule out there. If you've been involved in a multiple employer plan, a union, or I'm sorry, in a multiple unrelated entities in the same plan, or pooled employer plans, a new type of plan, the PEPs, those have a requirement to report all the participating entities and the amount of contributions. In the past, you did a supporting schedule. That's all going to be part of a schedule itself, its own form, if you will, within the reporting structure at this point in time. The audit requirements, we've got another slide after this one. We'll go take a deeper dive, but they changed the way in which audit requirements are going to be determined. In the past, it was based on eligibility. Now it'll be based on participant account balances. So that'll save a lot of the smaller plans that were requiring audits because they had a large eligible population, but a small participating population. I think the Department of Labor estimated that might reduce audits by around 19,000 in the coming year. So great news for some of the smaller plan sponsors that were subject to that audit requirement in the past. On your Schedule H of the financial statements, you're going to see more detail on administrative expenses being broken out. There's a specific line for auditors now, investment advisors. It used to be just one line for administrative expenses. Now there's a detailed line item for each type of expense. So take a look at that and make sure that makes sense. That's money that's coming out of participant accounts, and your fiduciary responsibility to make sure that those have all been approved, are reasonable expenses and appropriate for the plan. There's some more improvements in the PBGC covered plans that are out there. The IRS has finally gotten some questions onto the form that they've been wanting for several years. It's going to help them oversee and understand your plan's compliance with certain regulatory testing. So it's going to ask, what opinion letter number are you using from a prototype plan, for example, if you're using that? How are you satisfying your ADP, ACP testing? Are you a safe harbor plan? Are you using prior year or current year method? So again, those compliance testing results or methods of testing those now are going to actually be reported on the form itself. And the IRS wants to know how employers are satisfying those things. So they're maybe using that to target, particular types of employers going forward. Additional things that are in there as part of some annual rollover forms, instructions, other items as well included in there. So there's a much longer list, but those are probably some of the highlights for you. Again, this is just a chart where we go through some of the impact on determining whether or not you're subject to an audit. So the general rule to be considered a large plan and subject to the audit is that if there's more than 100 participants in the plan, an audit was required. In the past, participant was defined as those who are eligible to participate. Now it's going to be based on account balances in that. One other change in that as well is that for a new plan, in the past, or really the rule is you look at the participants on the first day of the plan year when determining if there's an audit required. And that still remains true, except that if you're a new plan, you're actually going to look at the last day of the year. So many times a new plan will start, well, there's 0 participants on the beginning of the year because the contributions may not start for a later payroll period, a transfer may not occur until a later time frame. And so a lot of times the first year didn't have an audit requirement on that. So that part has been changed. The rule is still in effect that if you did not have an audit before, for the first time, you can go up to 120 participants in that first year and still not have an audit. So look, I'm a visual person, so let's take a look at a couple examples of what that means. So in this first column, we've indicated what is a new plan and an existing plan. So we'll start here at the bottom. The new plans then, 0 participants at the beginning of the year. In the past, under those requirements, they wouldn't have needed an audit, but which was really not applicable. But now you're going to look at the end of year account, and they're going to need to have audits because they're over the 100 participants in the prior year. Going back up to the top for all these existing plans, we've listed what their eligible participants were at the beginning of the year and their account balances at the beginning of the year. So you can see on the first 2 examples, we had 300 eligible participants at the beginning of the year, clearly over 100, needed to have an audit in the prior year. They also had account balances over 100 at the beginning of the year in both cases, so they'll continue to have audit requirements. Looking at Plan C, they had 150 eligible participants, so needed to have an audit in the prior year. But notice that they only had 75 account balance. This is an example of really half of their population was eligible but not contributing. So they needed an audit in the prior year, but they'll no longer need an audit in the current year. Same thing in the example below, that even though at the beginning of the year they have 85 participants, the end of the year they have over 100 participants, but reminder, we're going to look at the beginning of year participant count. And in this instance, they won't need an audit for this year. But keep in mind that if their participant account continues to grow back up, they may need one in a subsequent year. So what we're doing with some clients is doing some procedures, some agreed upon procedure type consulting engagement where we would do some of the testing in there to help the plan sponsor ensure they're meeting some of the compliance requirements. And also if they become subject to audit again, we're doing enough work that we won't have to go back again and re-audit that. For those of you who've gone through any initial audits, plans that were in existence but didn't need to be audited, we're required to perform some procedures on opening account balances. And it can be somewhat painful to go back in time and locate those records. So for those plans that are kind of on the cusp of this 100 account balances, we'd be glad to talk with you to see if there's some limited procedures that we can do significantly less expensive than an audit, design those in a way to help ensure compliance, but also not have to go back should you become subject to that audit requirement again. Plan E was an example. They had 110 eligible participants, only 90. This one was a small plan filer in the prior year because they were still under that 120, so they've never needed to have an audit. So they're going to continue to stay under that audit threshold going forward. They're just actually a little bit further away from reaching that first 120 mark going forward. That was a lot. So if you guys have questions on anything related to if the plan needs an audit, we'd be glad to help with that. These numbers are all coming directly off the 5,500. In most cases, you can take a look at your 2022 5,500, see the number of account balances, because the number you had at 12/31/22 is likely the number you had at 1/1/23, which is going to make the determination for your audit for calendar year 2023. Wanted to just mention, I know we're dealing with our ACA reporting team right now is dealing with a lot of questions on electronic filing right now. In addition to all these 5,500 changes, there was another provision that's lowering the threshold at which you have to electronically file your information returns. Those of you who may be familiar with, there was always a 250 return threshold. Now they've lowered that down to 10. So the majority of organizations now are all going to need to electronically file things. That's including your 1099 series, your W-2s, all your ACA form, all those types of things that maybe you were well under the 250 and you still had the sort of convenience of filing on paper and maybe didn't have the technology to file things electronically. So like I said, we're dealing with a lot of people trying to get their Affordable Care Act forms out right now. We're not realizing they aren't set up for the electronic filing of that now that they're required to, going down to that 10 return threshold. So just wanted to mention, make sure you were aware of that. This law came out a while ago, so sometimes it's easy to forget that it's actually now in effect for these 2023 filings, that folks are trying to do in January and February. Well, I wanted to thank everybody. I don't know if we had any questions there. I know we're right about at the end of time here. any questions that we want to cover at this point, or we can certainly get back to folks after the fact.
Yeah, I mean, there was one question, if folks want to stick around for just one more minute. It's a pretty easy, well, not easy question, I should say, but the question is, I've heard people say to document committee meetings, but try not to add too much. What does that mean? And are there certain things you wouldn't want to include in the minutes? What I've seen in my experience is that in a lot of cases, the plan meeting minutes are only discussing investment information. And there is a lot of information that gets documented there because of the various decisions, because of, you know, how the investments have been performing over the past couple of years. So I have seen a lot of information related to investments, which might be what they're referring to, maybe a lot of investment information that doesn't need to necessarily be in the minutes. But what I'm also seeing is that there's not enough documentation around or discussion around the plan operations. So if the plan did have an amendment, or if the plan did decide to terminate or freeze, or if there isn't a discretionary employer match or contribution that should be approved by the governing committee, having actions like that and approvals like that documented in the minutes is also really important, because again, it captures that the fiduciary committee is reviewing and authorizing those type of transactions. I've also seen the SOC reports reviewed as part of the committee meetings as well, and I think that would be really helpful from an audit documentation standpoint to at least acknowledge that as part of your committee meetings that you are reviewing those SOC reports as well. I don't think that you necessarily need to get into the details of any participant transactions and documenting things like that. But again, anything that requires any level of kind of a review and approval of the fiduciary committee needs to be included in those meeting minutes. Karen, any other thoughts there? I know we're at the end of our time.
That's a great point. I think oftentimes plan sponsors rely on the investment advisor to do the minutes, and it is really a great summary of the considerations that went into selecting the funds. But then plan sponsors may fall short as they don't have their own minutes from adoption of things that might have been done outside of those committees. I think you don't want to put anything in there that would cause a regulatory agency reading it to create a liability or create a concern, right? Closing the gap on considerations and details. Don't put participant names in there or anything like that from just a confidentiality standpoint. So demonstrating how you've satisfied your fiduciary responsibilities and decisions that were made and some of the reasons for those. Some of the benefit of that is that you may not be the person sitting in the chair when the audit is done or when a regulatory agency may be coming in. So it's leaving that paper trail for the person behind you to understand why decisions were made and supporting different decisions that were made for the organizations when you may not have that institutional knowledge from your predecessors. So it really is a great documentation that you can leave to support for the plan. So I know we're at time, so I appreciate everybody's time today. It was great to reconnect with everybody. We're excited to get the next season launched. If anybody has any questions, feel free to reach out to us. As Cassie said, we love to work with you guys to help address questions, issues, and just be proactive and make it a positive audit process for everybody. It doesn't have to be painful, and don't shoot the messenger on when we find issues throughout the audit process. We're really just there to help you identify things early. It's much better coming from us than any regulatory agency because we have the opportunity to self-correct items. So thank you for everybody's time today, and have a great afternoon and stay warm out there.